Hello my dear friends and welcome to StudyIQ. I am Joy and from today onwards we would be starting a new series of lectures which would be based on the Indian economy current affairs for the past 15 months. That is from the month of January 2018 to March 2019. So I would be giving a special focus on your upcoming UPSC Civil Services Preliminary Examination. So based on the syllabus and the needs of the UPSC Civil Services Preliminary Examination, we would be covering the past 15 months Indian economy current affairs. So this would be a very helpful session for all those who are preparing for the upcoming Civil Services Examination, and I would be trying to cover all the important topics for your Civil Services Examination from the Indian economy portion. And I have divided the whole series into certain modules. The first module would be on banking and financial sector related current affairs. So here we will cover all the banking related or the financial sector related current affairs. And the next module would be the external sector, where we will cover all the external sector related current affairs. Then we will also cover various reports, committees and rankings of the country. And we will also go into various important departments and agencies, and in one lecture we will cover all the other miscellaneous current affairs related to Indian economy. So this is the plan, and in total 10 lectures we would be covering the entire Indian economy current affairs from the Civil Services Preliminary Examination point of view, and I am sure this will be very much helpful for all those who are preparing for the examination. So please try to watch the complete series, that is the total 10 lectures which would be covered under this series of lectures. So today we will begin with banking and financial sector. So I have divided the banking and financial sector into 3 lectures. So in total of 3 lectures we will cover the entire banking and financial sector related current affairs. So this is going to be the first lecture. Before we start, this is our channel StudyIQ, and we are providing pen drive courses for various competitive examinations including SSC bank courses, UPSC optionals, SSC JE courses, teaching examinations, railway examinations, defense examinations, RBI grade B, NABARD grade A, UGC NET, UPSC Civil Services Examination, for CLAT exams, for various state PSCs and also for various professional courses. You can visit our website www.studyiq.com for more details, or you can call to any of these numbers for more information. So let us start the whole series which is based on Indian economy current affairs for Civil Services Preliminary Examination. So we have started with the banking and financial sector, and here we will cover all the important topics related to banking and financial sector, which is very important for your upcoming Civil Services Examination. So the first topic that we will discuss under banking and financial sector is tokenization of card transactions. So this was an important current affair. Now coming to the current affair or news, the Reserve Bank of India has allowed tokenization of debit, credit and prepaid card transactions. So this was the news. Now what is meant by tokenization? Here tokenization of card transactions means that the card details would be replaced with a code, and this code would be known as the token. So now when you go to a shop, when you purchase something, you will either pay with your debit card or credit card. So here what happens is that instead of using your credit card or your debit card, a token would be generated, a code. Actually it is a code, and a code would be generated, and this code can be used to make the transaction. So here the advantage is that the card details are not transacted or saved. So without using your card, a code will be generated, and using this code, which is called the token, you can carry on the transaction. And the objective is to enhance the safety of digital payments. So we know that the government is trying to digitalize the economy, the financial sector. So the aim of the government is to bring in a less cash economy where the number of cash transactions would be minimized. So in this direction, the government and the Reserve Bank of India is trying to bring in maximum number of digital transactions. And one main concern regarding digital transactions is the safety and the security of the digital payments, where you are using your credit card or debit card and you are not sure how safe it is to provide your details to a POS machine. So here in tokenization, you need not provide any of your card details, or either the debit or credit card itself, but instead you can generate a code which is called the token, and the token can be used to carry on the transaction. So objective is to enhance the safety of digital payments and in order to make digital payments more attractive. So this is called tokenization of card transactions, and this was an important current affair. Now moving on, the second one is debt to GDP ratio. So the debt to GDP ratio was also a very important current affair because the central debt to GDP had come down where the debt to GDP ratio of the state governments had increased. So this was a very important current affair because this was against the recommendation of the NK Singh committee. So we'll come to the details of it. So first let us understand what is debt to GDP ratio. So what is debt to GDP ratio? It is a total debt as a percentage of GDP. So when you express the total debt of a central government or any state government, for that matter any entity, to that of the GDP as a percentage of GDP, it is called debt to GDP ratio. So debt to GDP ratio is the total debt of a government as a percentage of its GDP or the gross domestic product. So GDP is the gross domestic product, which is the monetary value of all the final goods and services produced in an economy in a financial year. So when you express the debt in terms of GDP or as a percentage of GDP, it is called debt to GDP ratio. Now coming to the current affairs, the central government's debt to GDP ratio is 46.5% in the year 2018. Now this has reduced from 47.5% in 2014. So compared to 2014, the debt to GDP ratio of the central government came down. Now coming to the state governments, with the performance of state governments regarding the debt as a percentage of GDP, in 2017-18 financial year, it increased to 24.3% from 24% in 2017. So in 2018-19 financial year, it is 24.3%. Now one major reason why the debt to GDP ratio of the state governments has increased is that the Uday bonds, or many of the state government issued Uday bonds, that is Ujjwal Discom Assurance Yojana. So that is one major reason why the debt to GDP ratio of the state governments has increased. Now coming to the famous NK Singh committee. NK Singh committee was appointed by the central government in order to review the FRBM Act. So FRBM is Fiscal Responsibility and Budgetary Management Act. So NK Singh committee was the review committee on FRBM Act, and the NK Singh committee recommended that the debt of the central government should be within 40% of the GDP and that of state governments within 20% of the GDP. Now consolidated debt limit, that is the central plus states debt limit, should be maximum of 60% of the GDP. So this was the major recommendation provided by NK Singh committee. This is a very important recommendation, and FRBM review committee is also very important both from your civil service prelims as well as mains point of view. Now if you look at the percentage of debt of central government and state government, the central government is moving at the right direction. It is reducing the debt to GDP ratio. But in case of state governments, the debt to GDP ratio is increasing, indicating that as a percentage of GDP, the debt of the state governments is increasing. So that is why the debt to GDP ratio was in the news. So this is also a very important topic. Now moving on, the third topic is angel tax. What is meant by angel tax? Angel tax is the tax on angel investments. Now what is meant by angel investments? Angel investments refers to investments made by companies or any individual for startups. So the capital or the investments provided to startup companies is called angel investment. Now what is the angel tax? The tax that is applicable to angel investments, and this tax is 30% on angel investment. So angel tax is levied at a rate of 30% on the angel investments, and this taxing on angel investments was introduced in the year 2012 in order to fight money laundering. Now here what is to be noted is angel taxation is applicable only on individual investors, not on venture capital funds. So these are some of the important points regarding angel tax. Now moving on, Next topic is RBI Autonomy. So RBI is the Central Bank of Indian Economy, and the autonomy of RBI was in the news frequently. Now talking about the RBI or the Central Bank Autonomy in India, the RBI does not have formal autonomy. This is because the government has a formal control over the RBI. Now, in this regard, a very important section is Section 7 of the RBI Act. Now, according to Section 7 of the RBI Act, it empowers the central government to intervene in the functioning of RBI. Section 7 is very important, and with regard to Section 7, I had made a special lecture on Section 7 of RBI Act, which is available on the StudyIQ channel. Remember, this is a revision class, or this is an exclusive current affair class wherein which we are trying to complete the entire 15 months current affairs in just 10 lectures. So I will not be going to each and every minute details, but from your preliminary examination point of view, whatever is important I will discuss here. But if you want to get more details of these topics, you can find separate lectures which I have made on each of these topics, which are available on StudyIQ channel. So if you need clarification regarding any of these lectures, or if you want to know in detail about any of the topic, please visit our channel. You can find the specific video on our channel, so you can go through. So remember, this is only an exclusive current affairs session for your UPSC preliminary examination. So whatever is most important, I'll cover here. Now coming back to the topic, Section 7 of RBI Act, which empowers the center to intervene in the functioning of RBI. So Section 7 provides for two types of interventions. The first one is consultation, and the second one is Central Board of Directors. Now, what is meant by consultation? Consultation means that the government can give directions to the RBI, and this can be done after consulting with the RBI governor in the public interest. So, in the public interest, the government can issue various directions or notifications to RBI, and that too with the consultation of the RBI governor in the public interest. Now the second one is Central Board of Directors. So here the general superintends and the direction of the affairs and business of the bank, that is RBI, can be entrusted with the Central Board of Directors. So this is the second option that is available with the government. Now let us understand more about the Central Board of the RBI or the Central Board of Directors. So it is a body that comprises of officials from both RBI, that is Reserve Bank of India, as well as the central government. So the central government will nominate members to the RBI, and the general superintendence and the direction of the affairs and the business of the RBI will be entrusted with the Central Board of Directors. Now the Central Board of Directors meets at least 6 times in a year and at least once in each quarter. And the RBI governor presides the Central Board of Directors meeting, and everyone has one vote, and in case of any tie, the governor will have a deciding vote or a second vote. So this is regarding the Central Board of Directors of RBI. Now moving on, we will see what is the case with transfer of surplus from the RBI to the government. Now this is a very important topic regarding the transfer of surplus from RBI to the government. So this was one of the major reasons for the debate between RBI and the government, and this was in the news very frequently. So this is a very important topic, and every chance that UPSC can ask you a question regarding the transfer of surplus from RBI to the government. Now before we move on to the question of transfer of surplus, we need to know what is RBI surplus. So the surplus of RBI is the difference between the income and the expenditure of the RBI or the central bank. Now, what are the income for RBI, or how does RBI generate income? The first type of income for RBI is the profit it generates on carrying out the operations. So while carrying out or while discharging the duties of RBI, it generates profit on its operations. So this is one income. Second one is the returns earned by RBI from foreign currency assets. So this is another income. Thirdly, RBI also gets interest on the holdings of local rupee denominated government bonds or securities, or it lends to banks for short tenures. For example, RBI lends to banks repo rate, reverse repo rate. So such type of lending and borrowing from the banks. So these are all earning some type of interest for RBI. Now again, RBI also gets commission on managing the borrowings of the state government or the central government, or handling the borrowings of the state and the central government. So RBI gets income in the form of profit, returns, interest and commission. So these are all some of the ways by which RBI generates income. Now coming to the expenditure part, RBI incurs expenditure mainly on printing of currency. Now other expenditures for RBI is maintenance of RBI staff. So RBI has to pay salaries to the staff, and also RBI has to pay certain commission to the banks for undertaking transactions on behalf of the government across the country. So these are the expenditures and income of RBI. Now what is meant by surplus? Surplus is the excess of income for RBI over the expenditure incurred by the RBI. So this surplus has to be transferred to the government, and some surplus has to be kept with the RBI itself. So the contention was regarding how much surplus needs to be transferred to the government. So this was the whole question. Now for that we should understand what is the nature of arrangement between RBI and the central government. In the year 1935, RBI was established, and RBI was established as a private shareholders bank, and it had a paid up capital of rupees 5 crore. So in 1935, RBI was established as a private shareholders bank, and in 1949 January, RBI was nationalized. So after 1949, the ownership is with the government. Now regarding the surplus transfer, according to section 47 of the RBI Act, excess of surplus needs to be transferred to the central government, and also RBI does not need to pay any income tax or any other tax like wealth tax on its profit or its earnings. And whatever surplus is being transferred by the RBI to the government will show it in the budget, and in the budget the government showcases the surplus given by RBI to the government under the heads non-tax revenue for the government. So it is a non-tax receipt for the government. Now this is regarding the nature of arrangement between RBI and the central government. All these points are very important for your preliminary examination. Now another important thing to be noted here is regarding Y.H. Mallegam Committee. Y.H. Mallegam Committee was established in the year 2013, and Y.H. Mallegam Committee recommended a higher surplus transfer to the government. So Mallegam Committee said that RBI should transfer more surplus to the government. So this is regarding the transfer of surplus between RBI and the government, and this was one major contention between both of them. Government demanded more transfer of surplus from RBI, while RBI was not ready to transfer more amount to the government. Now moving on, we will see RBI panel on economic capital framework, a very important panel. You should know all the provisions of this panel, especially for your mains examination, but here I will discuss in detail from the preliminary point of view. So RBI panel on the economic capital framework, it was headed by Bimal Jalan. He was the former governor of RBI. So this committee was headed or chaired by Bimal Jalan. He was the former RBI governor. And what is this committee all about? This panel is all about coming with recommendations in order to address the issue of RBI reserves. So we have seen what was the issue regarding RBI reserves or surplus transfer. So RBI panel on economic capital framework, it was a high powered panel. So it had to come up with recommendations regarding a formula on how to share the surplus between the RBI and the government. And coming to the terms of reference of this panel, first it had to decide whether RBI is holding provisions, reserves and buffers in surplus of required levels. So they had to decide what was the required level of surplus that RBI has to hold, and it had also to come up with recommendation whether RBI is holding more surplus or whether RBI has more reserves and buffers with it. Now secondly, it had to decide on a suitable profit distribution policy. So a proper policy or a formula that will decide how the profits can be shared between RBI and the government. And thirdly, it had to suggest an adequate level of risk provisioning. So here under risk provisioning, it means that how much amount RBI has to keep with itself in order to meet the risk and the contingencies. So these are the terms of reference of this expert panel. And economic capital framework refers to the risk capital required by the central bank for unforeseen situations. So this is all about RBI panel on economic capital framework. Now next is input tax credit, very important topic from your preliminary point of view. So input tax credit is directly related to GST or the goods and services tax. So what is meant by input tax credit? It means that the tax businesses or entities has to pay on the purchase, and this tax can be reduced in its tax liability when it makes a sale. Now to make it more clear, businesses or entities can reduce tax liability by claiming credit to the extent of GST made on purchases. For example, a company XYZ. Suppose this company or an entity, it is purchasing 100 rupees worth inputs. Now the cost of the output is suppose 500 rupees. Now in this 100 rupee inputs purchase, the company had to pay rupees 20 as tax for this 100 rupees purchase. Now the output value is 500 rupees and the tax on the outputs or the sale is rupees 50, let us assume. Now what is meant by input tax credit? It means that the entity or the business XYZ can reduce this 20 rupees from this 50 rupees when the sale is made. So it means that business can reduce the tax liability by claiming credit, or 20 rupees credit will be given to the extent of GST that is paid on purchases. So here XYZ has made 20 rupees tax payment while making the purchases. So while making the sale, they can claim for a rupees 20 tax credit, and that is called input tax credit. Now there are various exemptions under the input tax credit. Certain type of businesses cannot avail this ITC or the input tax credit. So what are the exceptions? First one, a business under the composition scheme. Now what is meant by composition scheme? Composition scheme means that the GST has to be paid at a fixed rate of the turnover. So that is composition scheme, and composition scheme can be availed by those companies that have lesser turnover, except for the supplier of services, manufacturers of ice cream, pan, tobacco, interstate suppliers, e-commerce suppliers, etc. Everybody can avail composition scheme if the annual turnover is within a particular rate. Now second exemption is for personal use. So for personal use also input tax credit cannot be availed. And thirdly, certain goods that are exempted from input tax credit, those also will not come under ITC. Now what is the significance of input tax credit? Input tax credit will help eliminate the cascading effect of tax payment for the business. Cascading effect means that payment of tax on tax. So this is cascading effect. So this can be eliminated. So this is regarding input tax credit. Now the next topic is Exim Bank. Exim Bank is Export-Import Bank of India. So why Exim Bank was in the news? This was because the cabinet had announced a capital infusion or a capitalization for the Exim Bank or the Export-Import Bank of India. Now regarding Exim Bank, it was established under the Export-Import Bank of India Act of 1981. So it was established by an act of the parliament, and it is a specialized financial institution that looks into the matters of foreign trade. So it looks into the financial matters regarding foreign trade, and it is a wholly owned by Government of India bank. So this bank is completely owned by the Government of India. So its functions includes extending LOC, that is line of credit, to overseas financial institutions, regional development banks, sovereign governments, overseas entities, etc. So this is the major function, and it also facilitates technology transfer. So here you should understand that it is not only finance but also technology transfer is included in the objectives and functions of the bank. So in preliminary examination, if a question comes and a statement like Exim Bank also facilitates technology transfer, so you would be thinking a bank has nothing to do with technology transfer, or Exim Bank is specialized in foreign trade, so you have a chance of eliminating their option, but it's not correct. It also facilitates technology transfer, that is financing import of technology into India and investment abroad by Indian companies. So this is briefly about the Exim Bank. So now in this lecture we have completed 9 important topics from your UPSC Civil Services Examination point of view. We will continue this series of lectures. So in the next lecture I will complete another 10 to 12 important topics for your UPSC preliminary examination from banking and finance module. So please watch all the videos in this series which will be very helpful for your examination. And you can also follow my Facebook page for any of your queries and for more video updates. And you can also write to me at joyce.studyiq@gmail.com. Thank you.